Treasury, and José María Rondán from Asociación Española de la Banca, who will take us in the next session. Thank you very much.
Pablo, thank you very much for moderating this panel, and thank you very much for the panelists. I think it was a really fantastic session. And as Pablo just mentioned, we would like to invite you now to the very last session of this morning or afternoon, depending where you are, and to a fireside chat between Mr. Jose Maria Roldan, who is a chairman and chief executive officer of the Spanish Banking Association, and Mr. Carlos San Basilio Pardo, who is Secretary General of the Treasury and International Financing at the Spanish Ministry of Economic and Business Affairs. So very warm welcome to both of you, and Jose Maria, over to you.
Thank you very much. Good afternoon from here and also from the UK, just if only for a couple of minutes. Carlo, it's a true pleasure to be with you. Long time no see, really. We have been seeing each other, over the screen, but not in person. I don't know, for many months. I wonder whether we have seen each other in person. I'm sure that we have seen each other in person in one of the periods of improvement, but really, meeting people on the screen is starting to be the new normal, part of the new normal. Carlos, I mean, we have today's session, which is called "Post-Pandemic Challenges: Role of the public sector." It has been an incredible 1 year that we have been going through. I mean, now that we are approaching that 1 year is when you really start to think. 1 year ago we thought we had problems, we had complications in our personal life, in our professional life, in the economy, in the financial system, but we didn't know really what was going to come to us. At the same time, we are here, we are alive, we are kicking, which is not bad at all, given considering where we have going through. So let me start by asking you, what is the view of the Treasury on economic and financial impact of COVID? This is a very, very, wide questions. We are talking about the economy, but also, the Treasury, the private sector as well, businesses have been obviously affected. What is your view?
Yes, Jose Maria, I don't know if you can hear.
Yes, absolutely.
Yes, so Jose Maria, indeed, it has been a very special year from all angles. On the economic and the financial side, we've been moving from some sort of an evolution of how we were looking at things in the early months of the crisis, and how we have been evolving over these almost 12 months already. We've been living with a significant impact of COVID already in the economy. And from the Treasury, from the governments, we have been adapting to the different circumstances. But the truth is that in this crisis, it has been so sudden and so dramatic that also my perception is that from our side, from the side of the authorities, the reaction has also been particularly sudden, particularly intense, and up to the challenge. And here I'm talking not only about the national authorities here in Spain. Well, I guess we'll have the chance to go into the measures that have been adopted, but also more broadly at the European Union level, coordination at the G20, and then on the financial side more directly by the ECB and other central banks. So the reaction has been very quick, and as I said before, I think that up to the challenge. Spain has gone through in a sense a particular route, given the importance that some of the sectors more directly affected by coronavirus have in our economy, particularly tourism. So here we saw a very sharp decrease already in Q1, very intense in Q2, and then a very drastic recovery in Q3, which gave us a kind of a sign of how different this crisis is from anything we've seen in the past. So which is the very steep shift of the economy that we have seen going down, but also going up. So Q3 last year, posted in the Spanish economy a rate of growth of close to 17%, which had never been seen in modern history of our economy. But it came after a decline in Q2 of even steeper of 18%. But what we saw in Q3 is the very rapid pace at which the economy can recover if we maintain the kind of the economic tissue, the firms and the workers and the whole economic framework in condition for a quick recovery. And that's what we saw in Q3, and that's what we expect to see also in Q2 and most notably in the second half of this year. So we've gone through this down and then up very rapidly, impacting Q2 and Q3. Then we have been in more of a less stable situation in Q4 and Q1. In Q4 in Spain, there was a slight GDP increase of 0.4%. It's still to be seen what we're going to have in Q1, but it's going to be probably somewhere along these same lines, plus or minus. But the truth is that what we are seeing is that the current containment measures that have been adopted in Q4 and still in Q1 have a much lesser impact in the economy than what we saw in Q2 last year. So here, our view is that we have to work to ensure that the recovery is as quick as possible. So we have to preserve the economic structure. And then on the financial side, we have also seen a situation, I would say, under control in all the different fronts, from equity to fixed income, from government bonds to private bonds. Here, the role of the central banks have been very important. Also, the kind of the joint effort and the very close coordination among, in the case of Europe, of the European Union member states. But in any case, given the very sharp decline of GDP, inevitably and also for many businesses, the difficulties to generate income, it has resulted in a sharp increase also in terms of debt from the public and the private sector. From the public sector, we had gone down in previous years to 95.5% of GDP ratio of public debt to GDP, which was almost 2% decline from the previous years, almost 4% decline over the last 3 years. But this trend has come to an halt, of course, in 2020, and we've gone up from 99.5 to roughly 117. So that's almost a 20% increase in terms of the ratio that we've seen for the public sector. But the truth is that the conditions under which the public sector, the Treasury, is funding itself are very positive. We saw some turbulence in the markets in the early months of the crisis, in March particularly. But then, after a very decisive action from the ECB, what we're seeing is that our cost of funding in 2020 has been the historical low. And this first quarter of 2021, cost of funding is close to 0%. So we're seeing maybe a reverse of the trend in recent weeks, and we would expect that the situation we had in the second half last year and the beginning of the year is not a situation to stay for long. But I mean the conditions under which the Treasury has been able to fund this larger pool of debt have been very positive. On the private sector, the increase of the share of the ratio of debt to GDP has not been that high. Has been in rough numbers, we see a 20% increase in the ratio of public debt. We are seeing a roughly 10% increase in the ratio of private sector debt. It is still remarkable, but it is well below the rate of the ratio of private sector debt back in the previous crisis, back in 2013, 14, in the case of Spain. So it's a situation where we have seen a reversal in the trend. of deleveraging, but as I said, we think that situations are still also in the financial market under control. Jose Maria, so we'll leave it like that, like a brief summary of the impact in terms on the economy and also on the financial side.
I think that you're totally right. I mean, this crisis that we are seeing is totally unprecedented. I mean, there's nothing like this. I mean, usually it was business cycle or real bubbles or financial bubbles. On this occasion, it's just almost a centralized engineer a downturn because of the lockdown and a quick recovery faster than we could ever thought. After the lockdowns are released. For me, it was very funny to see these headlines of Q2, Q3. Well, I mean, it's really pretty much irrelevant the fact that you have such a recession, the recovery after that. What matters is that we can see that we have been able to have the economy returning to normal very fast. Second element I would highlight from your comments, Carlos, the financial sector. I think that if you leave aside a little bit the volatility of that, small part, in March, that was most related to U.S. Treasury market rather than to the European markets. I think that the behavior of the financial sector, wider financial sector, I'm talking about the banks, but also the equity markets, high yield markets, the treasury market has been extraordinary, and I think that that's an element of comfort in the middle of this very very awkward situation. And the third element I would highlight is private sector. The private sector in Spain was deleveraging for the last 10 years since the last crisis. So really, I mean, we came to this crisis without, very strong levels of indebtedness on the side of the private sector. And of course, that room for maneuver has been very relevant in terms of facing the situation in a better place. Let me now turn, Carlos, to the second question. That is more related to the measures, to the concrete measures that have been taken in Spain, but also compared to other European countries. And also a little bit a review of the measures, and considering that on the one hand, this is taking longer than we thought. And on the other hand, we have vaccines that are working and that, we can see, really a light at the end of the tunnel. The tunnel has been longer than we all thought, but it's light at the end of the tunnel, which is something that we could not take for granted, 6 months ago. So what is the view of measures also a little bit with going forward, what you can see as things that can be discussed?
Thank you. The fact that the crisis is taking much longer than expected, it has definitely a negative angle, which is evident. But also we can imagine that had we known back in March last year that in almost March 2021 we would be still dealing with containment and confinement measures, we would have thought that it would have been something that would have had a much bigger impact in the economy and the societies than what we are seeing these days. The impact is big, but we have the view that we are in control, and that, as you were saying, some of these sentences that are becoming kind of a common ground these days. We are not out of the woods yet. We see the light at the end of the tunnel, but the truth is that we can say that we have reached this situation thanks to the rapid adaptation also from our citizens and private sector to the restrictions imposed by the pandemic, and also from authorities. We have been doing an enormous effort to try to help and support our societies, our citizens, our workers, our companies, to sail through these very difficult and challenging times. We have the perception that here most of European economies have worked very jointly. I mean, with comparable tools, comparable measures. From our side, we have been particularly active on two tools that we have, I would say three, that have been particularly effective. One of them has been mortgage and non-mortgage lending moratoria for vulnerable collectives, which is a very relevant social angle that you have to look at, and you have to keep very well under control. And here we have been taking advantage of as much as possible of the flexibility that has been given by the European Banking Authority in recent months. So moratory has been one relevant tool to address the needs of the most vulnerable. Then the temporary work schemes support, the ERTEs in our case, have also been extremely important in an economy, in a country where labor market has this kind of capacity to overreact in a crisis situation, and we have seen that although the effort on the budget side is being significant, because we are still going, ERTEs are still in place and will stay for some time. So all in all, probably we'll end up with a budget effort beyond 40 billion euros. But at the same time, we can see that the figures of the labor market in Spain have looked much better than they've done in previous crises, and the relationship between the decline of GDP and the increase of unemployment has changed completely. So we are seeing also that the ERTEs have been a very effective tool, and we've been adapting it as the crisis progressed to target the sectors where these tools were most needed. And also with the view that as soon as we start the recovery, it is a measure that ensures that the companies will jump into this recovery phase as quickly as possible, and we'll all benefit from that. And the third measure I wanted to highlight is that the very relevant role that public guarantees have had in solving the liquidity problem that many firms and self-employees have experienced since last month of March. Here we put in place a very ambitious program with a total of close to 150 billion euros among different state guarantee programs by the public sector. And it has been extremely effective, particularly in dealing with liquidity problems in the early months of the crisis, right until summer, and it's still being gradually used. But I would say that we have now more or less, in rough numbers, 100 billion euros of funding with the state guarantee, slightly above 80 billion euros, because our guarantees covered between 60, 70 or 80%, depending on the conditions of the total loan, which is good in a sense because there has been extensive use of the tool, which proves it has been effective. But it's good also because there's still room for some more to come as soon as the recovery is back in place and the companies have the right incentives for investment. So there's a subset of these guarantees that are particularly devoted to investment. So we think that it has played a very good role in the depth of the crisis, but it can also still play a relevant role throughout this year to support the recovery. We have been adjusting these original measures as the crisis progressed. As I was saying before, on the ERTEs, as I was saying, we were targeting specific sectors where it was more justified to extend the instrument. On the loans and the guaranteed loans, what we did is shifting gradually from strictly liquidity measures to measures first to promote investment, which is something that where we still have a lot of room of maneuver in the future. And also in terms of solvency, because the longer the crisis is, the more likely it is that what was originally a liquidity problem can eventually become a solvency problem. And given the very specific nature of this crisis, we are going to see companies that have solvency problems, but that have been particularly profitable right until the coronavirus. We see companies that had no problem at all of profitability or of solvency at the end of 2019, and that throughout this year have had to go through all the pain, and now are in a situation where they may have excess of debt that they will have to deal with. So we are giving them, we already took some measures last year in November. I would say we were among the first authorities to start working in this direction, which is to take into account that the longer the crisis is, the more important it is to give some room for the companies to handle their excess debt. And what we did last year was to allow for an extension of grace periods and maturity. I mean, in every case, within the state aid framework that sets very clear limits. Now we are working on a new package also in line with this original decision of November, kind of a Solvency II, that takes advantage of the new measures that have been adopted by the European Commission with the Fifth Amendment of the State Temporary Framework that gives more room for the public sector to adjust, for instance, our guarantees for additional extensions of the period for conversion or subordination. So it gives us more room to deal with the potential restructuring or refinancing needs that some companies will have to face this year and next year. So, Jose Maria, just to close, I think measures regional adopted were important and effective, and our challenge now is to adapt them to the needs of a longer than expected crisis.
Yes, absolutely. And I would say that from the point of view of the banks, I mean, we have been very active in these liquidity lines. What we are also observing is that in many cases, we are observing also an increase in deposits, not just of big corporations, but also of SMEs. And that indicates that many of the companies have positioned themselves in a precautionary mode, having liquidity, and that they are ready really to go into investment once all the uncertainties have disappeared. And the second element I would mention here is that this is not unique to Spain. We have a group of 30, report on corporate, evolution during the pandemic and going forward. And I think that there, we talk a lot about zombification of companies, but at the same time, there's a kind of for those of you who have studied econometrics, type 1, type 2 errors. I mean, should not allow zombie companies, but at the same time, we should also ensure that viable companies have the opportunity to go back to the market once, the crisis disappears. So we have the responsibility to do both things. And of course, easier said than done. Is still uncertainty is very strong. And, we would love to have, a silver bullet to understand, the differences among them. Carlos, before we go into the final part of the conversation, I want to ask you about the European Union. Really, one of the good things about this crisis is that the European Union has reacted in a way that we have not seen before, with issuance of true European debt. Can you take us, a little bit of how you have seen, the evolution of the European discussions, since the beginning of the pandemic to where we are today? That is a far better place than we have all thought. Next EU generation, of course, being part of the equation.
Yes, Jose Maria. Amazing trip, I would say, from in terms of the negotiations within the European Union since last month of March until where we are now. Had anybody told us where we would be 1 year down the line, we would have thought that this was really would be a very positive and probably unexpected outcome. Because I think that this time the European Union has as I said before, I mean, stood up to the challenge, and now we take for granted the recovery plan, next EU, next generation EU. Sure, all that has been done, but in the early months of the crisis in March and April, when we were discussing how to react, it was not so clear that we would be able first to have a very clear joint and consensual approach, and second, to have such an ambitious approach. Because the truth is that we have been, there's still to be done. I mean, the plan is approved, but it still has to deliver. But the truth is that I remember very well the night we spent negotiating the kind of the three instruments that were approved back in April, with the sure funds for employment schemes, with the ESM initiative, and also with the EIB initiative. So kind of these three backstops were very important, and were agreed in a matter of weeks, when usually for structural strategic decisions the Commission, the European Union, sometimes can take years. So here we delivered, and within a very short period of time we had a subset of instruments that were reassuring the commitment of all member states to support a joint strategy in this crisis, and to complement what was being done at the same time by the ECB. So it was very well coordinated decision from all sides. So this was kind of the first reaction to the crisis, and was fast enough. And then we engage in what is more the very strategic and second reaction to the crisis, which is the recovery and resilience plans, and everything within the Next Generation EU. That is particularly important from the European Union point of view from two angles. One of them is very evident, which is the fact that it should allow for a faster recovery out of the crisis for all European Union member states. And it's very well perceived that what is beneficial for one country is going to be beneficial also for the rest. So here we have a very powerful tool to help us recovering the economy to the levels where we were before the crisis, and back into an even more sustainable and more dynamic path of growth in years to come. Because the funds, are very significant, and also the way it is drafted, which is you have to invest where it pays. You have to adopt the necessary reforms to make sure that this investment is delivering in terms of growth, in terms of employment, in terms of wealth. This is one angle very important. Another very important is more of from a longer point of view, a longer perspective point of view, and goes beyond the coronavirus crisis, which is the fact that we have now an instrument for a common issuance of a common euro-denominated safe asset. So here we're moving in a direction that can help us progress also in the integration of the whole European Union project. So from all angles, I think that in the short term and in the medium term, the decisions adopted at the European Union level on the economic and financial front have been important and in the right direction.
Carlos, we are just 40 seconds to go, but let me ask you finally, about this debt sustainability. How do you view from the Treasury point of view the discussion? It's obvious that short-term targets are being, abandoned for good reasons, because now it's we need to do whatever it takes to recover from this, pandemic. Medium term, we are still, discussing all this. What is your view about, the discussions on this debt sustainability going forward, considering also that we have had a, logical but strong increase in the debt to GDP ratio?
Well, I agree with you, Maria, that for the time being, the focus is on being as active as necessary on the fiscal side to help the economy and the society deal with the crisis and get the economy back on the right track. Going down the line, if you look at the medium term, of course, we all are for responsible fiscal policy, and fiscal consolidation will be part of the toolkit. But what I would say is that once we get out of these very exceptional cases in terms of fiscal policy, when we go back to implementing the fiscal rules here within the European Union, we think it would make sense to give it some thought, give these rules some thoughts. They come come back from, from almost 25 years ago, from the original Stability and Growth Pact. A lot of things have changed since that time. The rules themselves have been complicated time and again. So now we are with a fiscal rules framework, which is sometimes difficult to understand and difficult to implement. So probably we have to work on one line, which is defining the set of fiscal rules which are applicable and at the same time deliver the benefits of fiscal consolidation when necessary. And also that's at the same time take into account that the figures, that the benchmark, the references that were used back in the late 90s do not necessarily have to be the same these days. So the 60% reference for debt to GDP ratio probably would make sense to be revised, because also, the equilibrium exchange of rate, whatever it is significantly lower than it was before. The cost of funding for issuers is probably structurally below what it was before. So it's not only from the point of view of the legislation of the procedures, but it's also from the point of view of the basics of the more of an academic point of view that these rules have to be reviewed, but taking into account that in the end we all will benefit from a responsible fiscal policy in the European Union.
Absolutely. My origin is fiscal policy expert at the Bank of Spain and also at the European Monetary Institute, the forerunner of the ECB. And the rules were complicated already, 25 years ago. So now they are even more complicated, and for sure there's room for simplification, clarification, while at the same time maintaining, the right tone in terms of sustainability. Carlos, thank you very much for this, very interesting conversation. And I'm sure that we'll see each other on a screen pretty soon. Thank you very much.
Okay.
Thank you.
Thank you very much. Thank you.
Okay, before giving the floor to Rick Watson, that should be, waiting around, and given that I have, eaten up a few minutes from what was, foreseen, let me just, conclude my presence here, thanking AFME for this second, conference that we have been, as partners. I think that it has been very interesting. The false Chinese curse. I wish you live through interesting times. Well, we have been living through interesting times, and a little bit after 1 year of these very interesting times, I would say that the feelings are a little bit dual. On the one hand, we have seen an incredible shock, totally different from what we have seen in the past. The lockdowns, longer than we all thought. But on the other hand, we are seeing some positive news. First, the resilience of the private sector, of the public sector, but in particular of the financial sector in all areas of the market. I'm talking about equity markets, high yield markets, the bank lending channel. The resilience of the private sector, and in particular the financial sector, has been an element of its strength during the crisis. The second element of positive element is the reaction of authorities. We are here talking about here of monetary policy, of fiscal policy, of member states, but also, at the level of the European Union, what we have been seeing, that Carlos was describing, next generation EU was unconceivable 1 year ago. And last but not least, and probably the most important one, we have vaccines that are working, and that we know that sooner or later, we don't know which month this year, but we know that the worst part of the crisis will be gone, in that once vaccines are widely available, and we are all able to be covered by them. Of course, we still don't know what the new normal will look like, but I'm sure that the new normal will be far better than the current normal that we are currently seeing. So with this, a short remark, I will give the floor to Rick for truly the closing of this conference. So, Rick, when you want.
Great. Jose Maria, thanks so much, and to you and Carlos for that very strategic discussion we just went through. And I was listening to your remarks about what we've learned today through your session, and in terms of how the public sector and private sector have pulled together to really focus on the impact of COVID. In terms of closing remarks, and before I do that, I just want to say that I wish we all, I'm sure you feel the same way, could be in Madrid like we were a year ago when we first had this partnership with the AIB, which for AFI's perspective is working really, really well to really pull together all the best aspects of the staff of each organization and their focuses and priorities to really focus on what the markets as well as the lending sector can do for the economy. I just wanted to point out for today's sessions, for those of you who were able to dial in for the whole day, there were 2 or 3 themes that I think came up in terms of lessons and things to take forward going for the future. First of all, when we started off with the covered bonds discussion this morning, one of the things that was very clear was a focus on the sustainable finance sector. And given all the discussion we just had on terms of the Recovery and Revolution Fund and how sustainable finance is going to be an important part of that discussion, I'm sure that the AEB, as well as other associations, but of course AFME and our colleagues at the GFMA level are very focused on how sustainable finance is going to be integrated into all aspects of capital markets activities. That theme also came up in the next session we had, which focused on what really we need to do for the SME sector. And we were delighted to hear comments, not only from the private sector, but also from ECO as well as the EIF to talk about their very specific and very timely programs, which are essential for keeping the SME sector going during this very difficult COVID environment. The third panel was on CMU and how essential it is that we really need to keep the CMU project going forward. We need the political momentum to keep going, and how that underpins how corporates access the markets. There's reference made to some recent work that we did in terms of hybrid instruments. We're looking for new ideas to try to bring capital markets funding in different types of ways and trying to do some new thinking about how we can bring money to corporates to basically help them get through this crisis over the next few months and years. So a lot learned. The session we just went through today, I think everybody will agree with me that there's a lot of insights, a lot of really important statistics of what the Spanish sector, the AEB, as well as particularly the Ministry of Finance are doing very actively to support the recovery. And with that, I'd like to shift gears a bit in terms of closing the conference. Unfortunately, we're at or near the end. And first of all, I'd like to note that this is the last session of the day, but please note you can stay on and continue to do some more face-to-face networking until 3 p.m. Madrid time and 2 p.m. UK time today. We'd certainly welcome you participating in the networking sessions. It's important to support our sponsors as well as to network with others and just talk about what we've all learned today. Right here in Umbrella, just on top of my image, you'll see a button that says live stream. If you click that, you'll find a drop-down menu where you can select face-to-face networking, the same as before. Make sure your camera and microphone are enabled so that you're able to chat with your other peers. Next step is, at this point, I'd like to remind everybody we'd really welcome your feedback on how we've done on this year's conference. On the screen right now, you should be able to see a very short survey. It takes less than a minute to complete. We'd really welcome that so we can reflect on what's gone well this year, what you liked about the program and the speakers, the length, the focus, the breaks, everything that you can think of. We really welcome your input. So please take a minute if you can to complete that form. This event's important for you, it's important for us, so your feedback is really important to us. And with that, lastly, I'd like to, first of all, again, thank our partners, the AEB. This partnership is going very, very well from AFI's perspective. And we really think we can put together the best quality program by working with partners such as the AEB, who really, of course, has a very established and high quality presence here in many different areas across the Spanish banking sector, whether it's in lending related issues, prudential issues, or of course macro issues, as well as markets. And we very much are delighted to work again with the team. Specifically, I'd like to thank not only Jose Maria, but also Juan Carlos Del Rio Pedro Cadarso, and Maria Abascal. We wouldn't be able to put together this event without you. So thanks again to all the team at the AEB. I'd next like to thank all of our partners. It's really important to recognize the important role that they play in putting forward this type of event. We have the BME, the Bolsas de Mercados Españoles, Spanish Stock Exchange, who's been a very long-standing APME member. We really welcome their participation. And actually, I think all of the different organizations listed today are APME members, and we're delighted about that. DBRS, European Data Warehouse, Fitch Ratings, Moody's Investor Service, and S&P Global Ratings, who are full partners. On the associate partner side, we'd like to thank again Tougher Minds and the Vienna Stock Exchange. I'd like to next thank all of our excellent speakers, both yesterday and today, who've given so much of your time, knowledge, and expertise to share with the audience today. I'd like to thank my colleagues at AFME, Richard Hopkin, who runs our fixed income and securitization divisions, Anna Bach, Pablo Portugal, as well as our events and communications team. So many thanks to all of you for a job well done. And last but not least, I'd like to thank you and our audience for joining us today. The last year hasn't been easy in a variety of respects, given all the disruptions caused by COVID, and your support and participation in this event at this virtual conference is immensely appreciated. So thank you again. I look forward to seeing you all next year, hopefully back in Madrid in person. And with that, I'd like to invite everybody to stay on for networking until 3 p.m. Madrid time, 2 p.m. London time, if you're able to stay. So thanks very much.